Hello. Today I'm going to talk to you about the future of banking. The origins of banking go back a long way, in fact all the way to 1472 with the Banca Monte dei Paschi di Siena. That bank can still be found today, as you can see from the picture on the left. More recently, book-to-capital ratios have been documented to have been falling consistently since 1840. So banking has been in a state of change now, effectively since the Industrial Revolution. In the past decade, however, that change has accelerated, and the fall in profitability, as measured by return on tangible equity, has become quite marked. We've seen leverage decline and fee income decline. You probably all know the reason for this. We've had a financial crisis. Banks lent too much money, and that money was unsecured. And as a result, the banking system was put under extreme stress, so much so that it almost broke the financial system as we know it and resulted in quantitative easing and a number of measures to effectively help and bail out the banks. During this same timescale, we've had advances in financial technology that's changing the very nature of banking. The bank's role as intermediaries, in particular, is changing. And that means that the nature of their services and the way they deliver those services is fundamentally changing. And I'll come on to that. This gives rise to a number of key questions. The central point of this presentation: what will the bank of the future look like? How will it depart from classic theory of banking? And to what extent does digital transformation play in this and explain these trends? How fast will this happen? This disintermediation, the cutting out of the middleman, how much change will we see in the way that we have banks as they currently exist? And what about the innovative applications, some of which we use individually? This all gives rise to a whole range of strategic options for established banks, and I'll cover those as well. But it also gives rise to a threat from shadow banking, from challenger banks, from social media, from a whole range of things, and I'll touch on those as well. The theory of banking goes right the way back to Edgeworth in 1886, and he postulated that it's based on the probability. It's the probability that you don't need to meet all your liabilities at one time. What does that mean? If someone puts some money on deposit in your bank, so long as not everyone who's put on deposit come and demand that back, you can lend out a multiplier of what you have in the bank and thereby increase your profits from that. The subsequent years in respect of theory of finance saw an evolution of the business model, and it extended this to a fee-based model and effectively a further proprietorial use of the balance sheets. In other words, investing in other businesses as well. Diamond and Rajan in 2000 extended this core concept and highlighted that the bank's capital structure depends upon its liquidity trade-offs. The bank is therefore an intermediary. And in that respect, Gurley and Shaw showed that this was a customer relationship where effectively you're borrowing funds by way of deposits and subsequently using them to lend and or invest, which is the assets on their balance sheet. In facilitating this mediation, they provide a service whereby they store money and they are the mechanism to transmit money. Obviously, if they're storing money, you have to have faith and trust in the banking system, because we would all like to have our money back if we put it on deposit with them. Now, as we speed up to the current decade, with improvements in financial technology, money can be stored electronically. Lenders and investors can source funds directly over the internet, and money transfer can be done digitally. So all of this is changing and at a very fast pace. So this change, the financial technology, is going to potentially disintermediate banking. And this leads again to the question we're talking about: what does the bank of the future look like? So I mentioned the classic theory of the bank that effectively you can use leverage because this concept of probably not everyone will ask for their money back at any moment, you get, as a result, this chart function where your loan iteration is a function of your money multiplier. Now, I mentioned the 2008 credit crisis. As we've gone from banking crisis to banking crisis, this focus on how much you have in reserve to meet this demand, if all the customers ask for their money back, is a key function of banking regulation. And we call that the Basel Capital Requirement Rules. In Basel II, introduced in 2006, they introduced 2 tiers of capital. So in that respect, you have a tier of sufficient capital to protect deposits and a tier of reserves, and thus optimize the profits of the bank. Subsequent Basel capital requirements has tightened up on these, but essentially the bank is still dependent on the capital availability and borrowers' creditworthiness. Nothing has changed in that respect. If we look at a banking balance sheet, it looks very different from the balance sheet of a normal company. You have your assets on one side and your liabilities and equity on the other, which is what you would expect from a balance sheet, but the assets are the loans that we as customers put on, take from the banks. Our deposits are the bank's liabilities. They have to come back to us and return that at some stage. There are also some trading liabilities because banks do trade, and there's a small amount of equity. The word bankrupt comes because there's this leverage inherent in this model and only a small element of equity, and therefore banks are prone to bankruptcy. Unfortunately, when you look at these loans and deposits, there is what we call a mismatch between long-term assets and short-term deposits. If I put my cash in a bank with the right to call it at any moment a deposit, but the bank is lending out my money to a big institution with a callback of, say, 1 year, 2 years, 3 years, or even for a mortgage product, 25 years, essentially you're creating a mismatch, which if more depositors ask for their money back, those loans are not recallable, and hence, again, there's a risk of bankruptcy unless it's well managed. So as a result, the banking sector is one of the most regulated sectors that there is. Why? Because Aunt Agatha wants her money back, wants her deposit back. And the threat to that is the leverage. So the banking inherently involves leverage and this mismatch, as I said. But as capital and liquidity are intrinsically linked to a bank's viability, you have to focus on what the risks there are. And the risks are credit risk and default risk. Is the person you are lending to creditworthiness, and will they pay you back? Will they avoid default on the loan? And again, as I said, Basel addresses that. Now, we've had 3 iterations of Basel, and we're moving on to the 4th. And the 4th effectively is tightening up a number of areas to prevent, hopefully, future bankruptcies. But the areas of focus are on credit risk, securitization, counterparty risk, market risk, operational risk, credit value, and step-in risk. And this is changing the various capital floors that the Basel mandates and the disclosures that the 3 pillars of Basel III propose and implement in a banking context to control the risk. Now, the reason I'm focusing at the beginning on Basel and the capital requirements is so that you understand that when we're talking about a changing industry, we're talking actually about a very complex industry. And it's very easy when you start talking about technology and how it can enable and how you can do peer-to-peer and how you can do it in a distributed way, forgetting the complexities of financial markets. So I don't think the challenger banks are just about to disappear, which many commentators talk about. That said, what they have to do is adapt or die, go out of business, because there are challenges out there. So how do they have to adapt? They've got to adapt a number of areas. They've got to adapt in terms of their liquidity transformation. They've got to adapt in the way they handle data. They've got to get people to trust them in a digital world in the way that they trust them in a bricks and mortar world. It's no coincidence when you go into a bank branch that is a great big solid building with a great big facade and so forth. That is done deliberately so that you trust that bank with your deposit. Competition is also heating up, and that's another element here, as is the digitalization of financial services, what we call fintech, the financial technology revolution. And this is all about innovation, and that innovation has been moving at a very fast rate. So until now, banks have traditionally been hesitant about technology. Why? Because essentially they're in the business of trust and technology, unless you have extreme security protocols, has what we call vulnerabilities. And because of this, banks have been very slow to adapt and change. Meanwhile, however, customers of banks aren't very happy with them because of this, because they haven't kept up. 37% of European customers said they would change their bank if they felt that they had and could do that with ease. So as a result, we're seeing an explosion in the facilitation of banking experience online, and much of this is coming from challengers. And we can talk about how that's manifesting itself as I go into the discussion. So it's all about new entrants and how they're focusing on offering just single service, but also how they're using APIs, application interfaces, to deliver banking services. So let's start with retail banking. This is fundamental to the understanding of banking because it's banking at its most simple form. In the UK, we've got 70 million active current accounts. With those current accounts, they generate effectively revenue for the banking sector of £8.7 billion. So not an insubstantial amount of money. Almost all adults have personal current accounts. But digital banking is having a very significant weight on that. And as a result, we're developing a bank in a box type concept. And digital challenges are moving in, particularly in a mobile world. But as I said, this public, all of these 70 million account holders are dissatisfied. So the CMA, the Competitions Market Authority, investigated banking in the UK, and they came to some interesting conclusions. There's a link here if you want to click through it, but way back in 2000, Sir Donald Cruikshank was asked to review this, and they created a parliamentary commission on banking standards in 2013. That commission found that the customer, again, was unsatisfied, but also that there are barriers to entry, and particularly technological barriers to switching customer accounts. So taken from that report, you can see here a quadrant chart that shows the leading banks. Now the left-hand quadrant, upper quadrant, is an area of dissatisfaction. And the bottom right hand is the area of reasonable satisfaction with banks. You'll notice that the banks that people are satisfied with, Metro Bank is a new entrant, First Direct is a digital bank, Nationwide and the Post Office are really more deposit takers and aren't really banks in the same traditional sense that we view them as. But the leading banks, Bank of Scotland, Barclays, Lloyds, NatWest, RBS and TSB, they are all the ones that people are dissatisfied with. Clearly, that isn't a good outcome. So the UK, effectively, in part of the European framework, proposed a new Payment Services Directive 2, essentially to make it easier to change banks. Now, Payment Services Directive 2, otherwise known as open banking in common terminology, has a number of quite revolutionary implications. So it was started so we could change banks easily, but actually it's resulted in some secondary considerations which are going to change the future of banking itself. So why is it revolutionary? Well, It gives a clearer view of your bank finances. That's revolutionary in itself. Some people never really get a full picture of what their bank finances are. It allows you to aggregate all these finances in one place. But in doing that, it also allows you to get the best deals, to use the internet to search for price comparisons and so forth. So we're all getting more and more used to doing that, but in a banking context, that's quite novel. The customer then chooses to give a regulated app, a API, the ability to access his current account information. Now that facilitates not just quick and easy and direct payments and quick and easy switching of accounts, but it also means that that data can then be used in totally different ways, and that totally different approach means that there's going to be new contenders to do things that banks aren't really doing with that data, and that's what's revolutionary about it. Now, the UK's got a lead on this, and in 2018, effectively went live with the Payment Services Directive 2, first country in Europe to do it. We passed the 1 million mark in fairly short order of people using open banking, and a large number of countries are following suit. Australia, Argentina, Brazil, Canada, Hong Kong, Japan, Mexico, Nigeria, Taiwan, and New Zealand, all considering adoption. Part of the PSD2 legislation is to introduce 2 new financial service providers, ASIPs and PISPs, account information service providers and payment initiation service providers. Why? Because now you've got people who are able to mandate accessing to your bank account, so you need to control and regulate them. You need to control and regulate the payments that they can authorize and make sure that that information is used in a proper way. So not just turning the banking industry on its head, open banking is also creating 2 new industries, of which a whole raft of new companies are being created as we speak to address that. Now, what these companies are using are APIs, application programming interfaces, and that's really just something that defines a computer's or an individual's interaction between multiple software intermediaries. In other words, it's the protocol that these formats go through. So coming away from the technology, it's this, it's your API. Here we've got an API that shows and lists the number of banks, and you have the Danske Bank in this position, which is allowing you to aggregate your other information from your other banks to your banking information, so you get consolidated information, all part of the open banking revolution. So what do these APIs do? What do they do for service? Well, they build a secure service, that's why it's regulated, and an efficient service. But they also allow access to a larger market in a faster way for the third-party providers, for the new entrants. So if you're a startup, a fintech startup, and you are entering this marketplace, suddenly you've got access to all these 70 million UK banking customers, a phenomenal change and game changer. And it allows people to build single solutions on an API addressing very specific problems, like, for example, what is my credit rating? And it's important that these APIs, because they're part of this regulated oversight, that again puts trust at the core of financial services. So on APIs, there are 2 sorts of APIs. There are data APIs and payment APIs, hence why we've got 2 types of regulated entity. So the data APIs, they do things like your identity, your account, your card, your balances, your transactions, and what sort of insights you can get out of it. And obviously the payment stuff, they're doing the settlement, they're doing the avoiding the fraud, the transactions, the integration, and so forth. As you can hear, it's a very interesting and changing world. The incumbent banks make up the majority of banks, but there are actually 4 scenarios for the bank of the future. There are the incumbent banks, there are the challenger banks, the distributed banks, and the disintermediated banks. So the incumbent banks effectively are changing the legacy banking into a digital world. And the majority of banks are in this position. So they need to be aware of the financial technology that can make that happen. The challenger banks are built for designed digital banks. They've been started from scratch as digital banks. Their big challenge is a regulatory one, and also how do they get new customers. The distributed bank are effectively those that are aggregating services from others, using this open banking to create banking as a service and create it with a permissioned way, even though they're not a bank in their own right. And then we have, again, a new world, a disintermediated bank. So social networking, these big platforms that we use to buy and sell things and to search for things and so on, they are repositories of data. And as data is changing and as our buying habits are going online, there's no reason why these sort of entities might not evolve into banks, cutting out the bank as a middleman and providing that service for themselves. Think with, for example, Amazon and their introduction of Libra as a digital currency. So a very complicated world to be facing when we're talking about the bank of the future. What is clear is the bank of the future is about IT, investment technology, information technology. The spend on IT at banks is quite simply going up every year and is expected, according to eMarketer, the data here, to go up in the US to 83 billion a year by 2024. So these are very high growth rates, significantly higher than typical normalized GDP growth rates. And so as a result, you could say that banks aren't really using technology, they are becoming technology companies in their own right. Certainly JP Morgan views themselves as more a technology company than a bank. They've stated that publicly. If you break down that number further, you will see that actually the spend on digital technology is obviously far more important from the point of view of what's being spent each and every year. So going back to 2013, in Europe, only 13% of the spend was on digital technology. Now, obviously, we've got a number 3 times as high as that as we move into this new digital landscape. And that in only 10 years is a really dramatic change. In terms of the power of digital delivery is already here. And in, for example, the Middle East, you have, for example, digital assistants.
Hello, you can now ask me anything about Eva from her perspective. More information about our product.
So as you can see, quite a fascinating world that we're entering into. In scenario 1, the incumbent banks that I mentioned about, these are the brick and mortar banks. These are the ones where customer satisfaction is low, as the chart on the right shows. These are regulated, but they do own their customers, and we shouldn't forget the value of that. So if they digitalize themselves and they change the customer satisfaction, they will hopefully benefit from the changes that we're seeing. So they play a rearguard defensive, but obviously changing approach. So for example, let's take Bank of Scotland. Their flagship branch in Argyle Street was opened last year, and you can see it's got a very different look and feel. This is the largest and busiest branch within the Lloyds banking group network, and the customer experience is central to everything that they're doing. They took a 2-year period to redesign this and prototype it with what they call micro branch. So you can see having coffees with advisors and being able to do things without, in some cases, human interaction. In the States, They have a very impressive sort of flagship store, for example, for Capital One Bank. And again, you can see it's a vastly different banking experience that you get from that. So there you see, Pete's Coffee Shop in Union Square is now a bank. But we have a whole lot of new challenges because we've got industry transformation going on. There's a trade-off with these new challenges between capability and market potential. So it's all very well to create a small app and a bit of digital infrastructure or whatever, but you're still competing against billion-dollar banks. So as a result, quite a lot of these challenger banks have become niche players, but more importantly, the more successful ones have become those who deliver the best digital experience. I also include shadow banking in terms of challenger banks. So shadow banking is where effectively lenders and borrowers are interacting but outside of the banking sector. So if you think of a big company like Nokia selling a third generation mobile network system, they would use vendor financing and are providing lending to people who want to buy that infrastructure. That is part of the shadow banking world, as is a large number of other things like securitization, like money markets, like hedge funds. And this has become a really large part of banking and a big concern, incidentally, to central banks and regulators, because this is lending which is taking place in a more unregulated environment. We also have the distributed bank. So this is where you're moving the banking ledger, the old-fashioned paper ledger, to a distributed ledger, to computer servers throughout the world over the internet. And this is a world that uses gateways and digital wallets. The problem with that is obviously it's only as secure as the technology on which it's stored, and it also has both user identification and security for the individual deposits and so forth. So immense challenges, even though it's very exciting. You'd probably more come across distributed in a financial context from the crypto assets, cryptocurrency world, where blockchain is used in a distributed ledger to effectively do transactions, whether it's Bitcoin or Ethereum or the 250 other sorts of crypto assets that are traded out there. So in terms of the digital approaches to banking, you've got incremental approaches, more likely to be done by the fundamental players on the bottom of this chart and the disruptive at the top. What I've just talked about, digital blockchain, is more disruptive. The digital ecosystem, again, something like how the front office interacts with the client is also slightly disruptive, because as you saw, you can have things like digital assistants, but there are also things like advisory services that can come and custody services as well. So then we move on to the disintermediated bank. So banking is mediation, is putting these lenders and these borrowers together. And in that respect, disintermediation is cutting out that middleman. In other words, cutting out the bank. And this chart shows how it's done. Essentially, what you're talking about is a peer-to-peer environment. These lenders and borrowers are meeting in a digital way, for example, over the internet, with the intent to do that. The problem with this is it's decentralized. Some people say that's an advantage, but decentralized also means there's little or no counterparty protection. So either the regulator has to catch up with this, or we're going to find that some people are going to get burned in the process of, as we talked about the theory of banking, banking is probabilistic about getting your money back. It's as your grandmother suggested, you never lend to someone who needs the money. Essentially, what you need to do is you need to get paid back. And in a disintermediated world, you can use data to assess whether that will happen, but actually you don't have the same advantages that traditional banks have. That said, there is a growing importance of non-banks. Again, I mentioned the shadow banking market, and in that respect, these approaches are also disintermediating and cutting out the banking middleman. Harnessing blockchain and AI will really enhance a lot of what we're talking about, and that is the future. Banks are recognizing this, grasping this. They are in a consortium approach, like for example with the R3 consortium, working out ways to do transmission of financial assets, transactions over blockchain. This isn't going to go away, and it's something that creates immutable record, i.e. records that can't be destroyed in a secure, cryptographically secure way, which is of course what you want from a banking system. So there you have it. In conclusion, banking is changing. It's technology that's driving that change, but this pace of change is accelerating. There you'll see a credit card on the left from Banco de Bicassi, who, as I said, is the oldest bank. Clearly, they have kept pace with change. Open banking is facilitating this change, and open banking originated by wanting to change banks easier, but is also now changing that ownership of data from the banks to the individuals and to third-party applications, which we talked about. All this is facilitating new digital services. So we're moving to this world of banking as a service. The incumbents, meanwhile, are reinventing themselves, thereby making it an open playing field, and certainly very interesting from the point of view of the disruption of innovation. In fact, the disruption of innovation is still manifesting itself, as we haven't really even seen how social media and other new entrants are going to be addressing all of this. But we have seen how digital banks and the mortar banks are addressing it, and we are seeing the creation, as I just shown, of some interesting new banking concepts. That said, despite all this, there is a growth in shadow banking, there is a growth in digital banks. Banking is being disintermediated, and we can already see that this bank of the future is here. So I'll leave some time for questions, and otherwise, thank you very much for listening.